To me, I think the credit cards that's one of the more attractive areas now because the yields on the assets are still very high, meaning you're making credit card loans at 10, 12, 15, 20%. That's a lot better than making a mortgage loan at 4%. I like things like Capital One and Visa and MasterCard. I mean, they're not lenders, but they're transaction-oriented. I think the economy is going to, again, the government's stabilizing the economy, so I don't think transactions are going to fall that much. And, even Discover. And then I look at I like the credit collectors. We have a lot of bad credit. I think we've had north of $3 trillion of loans that have been written off in the U.S. alone since 2007. So there's a lot of credit that's been written down, and a lot of it's been written down close to zero. So these companies go in, buy them at some very, very low price, and then work them out. And if the economy stabilizes and even gets a little better, and jobs come back even a little bit, those people will be able to make those payments. Another area would be the very safe, well-capitalized small-cap banks that are going to take advantage of consolidation. And then the fourth group would be sort of those people that have collected assets or had a lot of bad assets at the bottom or at the top and are now working through them or have bought a lot of toxic assets. And that would be, like a KKR Financial would be a good example of a company that is, they have a lot of toxic assets they bought, and now as those assets, if they bought them at 10 cents on the dollar, if they sell them for 20 cents on the dollar or something like that, or hold them to maturity, you can make money that way.
People say the U.S. doesn't make anything. Today, the biggest market cap sector of the S&P 500 is, guess what? IT. And we do that. We do export it. We do make it. We're good at it. The rest of the world loves this. It's a sector that has double and triple the free cash flow margins and EBIT margins that it had 10 years ago. So from a valuation point of view, there are 3 product revolutions going on in IT as we speak. It is an implied call option on India and China because the growing middle class wants our smartphones, they want the apps, they want all these devices and the software that comes with them. And these companies are sitting on massive amounts of cash. So either there's going to be dividend increases or mergers, or they're going to buy back their shares, but this sector has to do something with its cash. It's sitting there like a time bomb waiting to go off. Valuations are not rich, and yet earnings are spectacular.
We definitely favor the foods and eggs because we think people have to eat, and you've got this perfect storm of demand. You've got food, feed, and fuel. In addition, you have this shift of wealth from developed economies to developing. And when you do that, and the income's growing, and we all know that as incomes grow, you move up the protein food chain. So you eat more, meat, chicken, beef, pork, and that takes more grain.
A company like Texas Instruments, it's gone up some the last few months, but a cyclical growth company that is a leader in its field, that reinvents itself every 8 or 10 years as its world changes. The economy can go sideways for quite a while, but there'll be a lot of game consoles and retrofitting of motors for energy efficiency and a lot of things that people don't usually think about. Berkshire, I think we don't need to talk a lot about, but it's the best asset allocator with great assets generating tons of cash and probably selling at 75 cents on the dollar. I love Berkshire. But something more obscure like Omnicare is a company that delivers pills to nursing homes. It's the biggest at what it does, and so the stock is $22 or $23, and it's generating over $3 a share of free cash available to the shareholders and growing. When you're buying it at 7 times free cash, growing with a management you like,
sounds hard to argue
I'm
with.
in heaven.
Yeah, right.
We're like rocks in the ground. Internationally, we own a company called Heidelberg Cement, German listed, probably the biggest aggregates company you've never heard of. When you combine pricing power, cost control, and aggregates, they don't decay. I mean, the rock stays in the ground for a long time. You have long-lived assets. You put all that together, and you have the hallmarks, really, of a great business.